Another great guest joining us right now. Richard Saperstein is CIO over at Treasury Partners and decades of experience on Wall Street. Great to have you here.
Thank you.
Cuts. That's all anybody talks about. I know Jay Powell doesn't want us talking about that, but he's got to address it, right? I mean, they've got to put out a statement that at least provides a hint of maybe what they might do and when they might do it. You think we're going to get that?
Well, we're in the third of four phases in this tightening and loosening cycle, where the first one started in 2008 with the zero interest rate policy, and then in March 22 that ended with the tightening cycle, and now we're in the third phase, which is the monitoring cycle, and that began in the third quarter of last year. We expect that to continue right through the third quarter of this year with no cuts. And what that means for investors is that we should be looking at extending bond maturities prior to rates going lower. So irrespective of the language that comes out today, the boots on the ground people that run money like me, we are extending maturities.
Is there any doubt in your mind, at least, that rates will be lower at some point this year than where they are right now?
No, because I think the bite of Fed tightening is still occurring with declining leading economic indicators and CRE loans. I mean, there's a lot of problems that are under the surface. Economy should slow, and slowing economy will get the Fed to accommodate, and rates will go lower this year.
Is that going to be enough? Is that going to be too little, too late?
I don't think so, because we have a very robust labor market. So there's still 1.4 jobs available for every one unemployed worker, as compared to the peak of 2 and the average since 2000 of 0.7. So labor market is robust. Inflation's coming down. I think the economy sustains itself, but it has a slowing bias.
The labor market is robust, so too are wage gains, and we're going to get another peek at that on Friday with the monthly labor market report. And we know Powell and company have kind of been obsessing over this. And are the wage gains actually concerning to you, at least from an investor perspective? Because I know they're elevated, but it seems, at least based on where we are right now, given how far inflation rate has come down, it seems like we can live with that, right?
The wage gains are growing at a slowing pace, so I don't really find it too much of a risk at this point. I think the tail risks right now are going to be, some supply chain shortages as a result of the Red Sea issues, the hot wars going on. That's what could cause inflation to temporarily spike. But the direction is lower inflation, lower rates.
When you consider how far we've come from, what was the headline rate, 9%, 9+%, and when you look at those core numbers and how far they've come back closer to the Fed's target, we're not there yet here. Do we give the Fed credit for that?
Well, we give the Fed credit for not tightening and ending QE sooner, because remember, in Q1, inflation, CPI, averaged in the 8s, and the Fed didn't do anything until March. So at this point, we applaud the Fed for the 18-month tightening campaign, moving the rates back up to 5%. The biggest mistake that could occur at this point is premature accommodation. So the Fed cuts, and all of a sudden you get a temporary spike in inflation. All of a sudden now that's more volatility for the market. That would be the biggest risk.
And financial conditions do look relatively loose. I mean, at least by the Bloomberg indicators, and I think Goldman Sachs has an indicator that tracks the Bloomberg one pretty closely as well.
Yeah, look, there's still liquidity in the system, and there's corporate debt being issued. What we really have to focus on is QT, which really isn't getting mentioned too much, but as liquidity starts to dry up in the system, then we're going to start seeing the Fed talk about, cutting back on QT to $60 billion a month that they're letting roll off.
When you say cutting back, just slowing the pace of the runoff, or putting it on pause?
Slowing it.
Okay.
The issue is, last year, the federal government spent $6.2 trillion, but only took in $4.8. So they basically overspent by $1.4 trillion. That's nice. So they had to issue, and that's going to continue into the future. At the same time, the Fed is letting $60 billion a month roll off in treasuries. So that, and both of those amounts have to be reissued this year. And that's one of the risks as a bond market investor, in that the supply requires higher rates to clear the market.
When you look at, I guess, portfolio allocation, and I'm talking more broadly, not just for someone like you, who is, of course, much more married to the fixed income space, is there a case to be overweight fixed income based on the predictions most people have for Fed rates this year?
Well, for our clients where the return of capital is more important than the return on capital, we look at the overall asset allocation between stocks, bonds, and hedged investments. And we're maintaining roughly 40% allocation, 40% allocation to fixed income, 40 to 50% in equity, and a small allocation to what we'll call hedged investments. But I think it's important to maintain an equity exposure here.
All right, Richard, going to have to leave it there. Richard Saperstein, CIO over at Treasury Partners, helping us sort of frame things here as we get closer to that Fed decision, 2 p.m. Washington time. Coming